Take your seats. So I'm starting with the topic valuation in Indian regulatory environment. How I have structured the presentation is into 4 parts. Overview of valuations that we already have a fair idea by now. Indian regulatory environment, that is the core topic. Taking it to the registered valuer, which is very hot these days. And then some of the tricky issues, when I was also sitting, there were certain questions that were coming, how to do this valuation, how to do that valuation. So I would like any of the questions, if you can just ask, we'll try to address that. I'm starting from the overview of valuation. So this we have understood that valuation is an economic concept, it's an estimate, and it is depending on certain things like there will be certain assumptions, there will be certain limiting conditions, and there has to be data available on the valuation date. So these all bold points play a very crucial role in determining the valuation of any entity, any business. If you go through this slide, then valuation and the business and the country follow the law of economics. So there were questions that when we are making projections, then can it be 10, 20, 30, 40, 50? Or it has to be 10, 20, 30. We have to see the industry, like sugar industry, you take an example. It operates for a part of the year. So such kind of scenario is not possible. Second thing, apart from industry, is that what is the stage of the business? So whether the stage of the business is a startup, whether the stage of the business is growth, whether it is a distressed company, whether it is a declining company. So what is the stage of the business? That is very important, determining which methodology we have to use, how we have to evaluate. So there are certain parameters that we have given as to turnover, profits, track record, methodology, cost of capital. Because these are some of the challenges that we value, where we should take more cost of capital, where we should take less cost of capital, whether we should use discounted cash flow, whether we should use the book value, whether we should use income approach. So this slide will give you a fair idea of how and different, so this presentation will be circulated, so you can have a note of that. Third question that comes to my mind is there is a very question in, so valuation experts know this, but a general layman, industry people fail to understand that whether it is an equity value or it's an enterprise value. So when we value, then there are two things that are important, that which valuation methodology we are using and what is the result of that. Is it yielding equity value or is it resulting in the enterprise value? So that is one side. If we see the right hand side, value of business, another question that is important is that how to value intangibles. So there were certain discussions that was taking place. But the answer to that is important is that whatever is the business valuation, intangibles is a part of that valuation. So there are clients which say that you have done a net asset value or you have done a discounted cash flow. So that is my business value. But I have my distribution network, I have my brand, I have my HR. How to value that? So you add on a value to the value you have derived using a suitable method. That the method that we are using must be a method that takes into account the value of the intangibles. Because valuation is not done that you value without intangible and then you separately add the value of the intangibles. So this is another crucial thing. Third point which I want to highlight is that this debt that is written and all the assets and liability, when we are doing valuation, the valuation should typically be based on the market values. So valuation should not be considering the book values, it should be considering the realizable values. It can be more, it can be less also. As to the approaches, one approach is fundamental. If we talk of fundamental, there are two methods or two approaches. Asset method is also fundamental to the company. Income method is also fundamental to the company. It will value a company on the basis of its inherent strengths. In income, it can be either historical or it can be a projected. So projected is discounted cash flow. Historical is capitalization of earning. I'm not going into methodologies, I hope you have discussed that. As to the asset, it can be again book value method, realizable value method, or liquidation value method. There is another method which is known as a relative method. So suppose we have valued a company on discounted cash flow. The value is 5,000. But what if a similar company is available at 2,000 rupees? The value of the company will not be 5,000. There is a comparison to the valuation of the company considering the market. Now there are three types of market value methods. One method is the comparable companies multiple method. It is applied in case of listed peer companies. So comparable companies has two things. One, what we have to keep into mind is the valuation that a comparable company in market is getting. That is not a control value, that is a minority value. Because suppose I have to buy Reliance Industries shares. I can't buy Reliance Industries entire company. I can get only a 1%, 2%, 5% float. And that price which I am getting, that's a minority value. So by concept, CCM method yields to minority value. There is another method that is linked with the transactions those are taking place in the market. We call it CTM, comparable transactions method. Because there is a transaction taking place in the market, transaction means that there is some private equity, some investment transaction is taking place. So by concept, CTM method results in a control valuation. Because the first method is the market prices which are available, that is generally a minority valuation. And second is CTM method, that is a control valuation. There is another third method. If you have to value a listed company, then the market price available is generally considered as fair, provided that the price or the shares are frequently traded. So there are three approaches: market, income, and asset. But practically we also apply some other methods, specifically like the contingent claim method. So contingent claim method is basically an option pricing valuation. If you have to value a ESOP, then we value this. If you have to value a patent, then specifically we can use this option pricing method. There is another method, price of recent investment method. Now price of recent investment and comparable transaction multiple are very, very similar. The only difference is that price of recent transaction or price of recent investment is talking that there is some investment that has taken place in the company itself. And CTM says that there is a peer company in which the transaction has taken place. And what businessmen like the most is rule of thumb. So what they say is, if there is a hospital and there are suppose 100-bed hospital, and they would allocate a 1 crore revenue to each of the room. So 100 crore is the valuation. Now this rule of thumb method is a very, very useful method, but this method should never be applied solely, and it should be a test check of all the other methods. So by one slide, I have tried to demonstrate that these are all the methods, whether I do the valuation, any big four does the valuation, any international player does the valuation. You cannot go beyond these methods of valuation. These are the whole and soul of valuation. So you have to select, and when you have to select, 2-3 things, either it is a minority valuation, is it a control valuation, is it a transaction valuation? So what is the purpose that determines the valuation? Two things which are important from a valuation perspective is, one is the cash flow. So what I'm trying to do, I'm trying to build on that what are the important factors when we have to value. So one thing is cash flow and one thing is assets. Investors always prefer a cash flow valuation method. So that is why discounted cash flow method is the prominent valuation methodology. As far as the assets are concerned, always see that there could either be an operating asset and there can also be a non-operating assets. So there is a business which is having a land and building, and that land and building and plant and machinery is yielding the revenues. So you can, suppose you have used the income method. Now, once you have used the income method, you can't add the value of land and building to the income method. So it can either be an income method, or it can be an asset method, or it can be a market method. But if the revenues that the company is getting, those revenues are, there are certain assets which are not resulting in revenue. So I am having a surplus land. That land is not resulting in any valuation. I am having a surplus cash. So if there is something on the balance sheet on the asset side that is not resulting in any cash flows, then that needs to be separately added to the business valuation to get the total enterprise valuation. But here, the people, you might appreciate, recently when Mr. Narayan Murthy was not there in Infosys, then there was a lot of speculation and lot of things that Infosys is holding a lot of cash pile in the balance sheet. And it was not getting a valuation. So going by the concept that I just discussed, that if there is excess cash, if there is excess asset, surplus asset, it should be added. But that is not how the capital market operates. So the valuation things that we are discussing it more from a unquoted share, more from a closely held company. In case of market, in case of the stock markets, they have their own ways of determining. It can be rational, it can be irrational. But the concept that I have just shared, that concept is logical from a perspective of valuation of an unquoted share. So what I'm trying to say is that if there is the same set of business, same set of assets, it is a listed company, it's an unlisted company. The market can give a different valuation. If we have to value, we can arrive at a totally different valuation. These are all the areas where valuation depends. So it can be depending on the purpose, it can be regulatory, it can be accounting, it can be dispute, it can be value creation. Different things, I'm not going into detail. Which method to use, which approach to use, again, on whose behalf we are doing it, what is the purpose, and what is the condition. So I was just discussing with a gentleman that 3 months, 4 months back, things were in distress. We are seeing for the last 1 month, there is a momentum going on, there is a positivity going on. So when you value is very important as to what number it will yield to. If we see the judicial approaches, I think in standards, Mr. Rajiv Singh must have discussed that there are no standards in India, not much standards. So there is an ICAI standard and all that, but there are some judicial pronouncements which say that which method you have to use. So what the judicial pronouncements say that income approach is to be generally used other than the case wherein you have some asset heavy industries wherein asset approach is to be used, and market approach, as per if we see the judiciary, then in the judiciary there is no mention of CCM, there is no mention of CTM, PORI. These are practically used internationally accepted methods, but if you see any judgment of any court in India, then it will either talk of your asset value, or it will talk of your income value, or it will talk of a market value. And in market specifically, it is only talking of for a listed company. So we just discussed that before 1991, it was CCI guidelines. And at that time, even DCF was not known that what is DCF. So DCF actually first came into India in 2010. I'll just discuss. These are some of the rule of thumb, which, so what I've tried to give, that which industry is there, what is the value parameter that we can use. You can just go through it. Moving on to the second purpose that is important, Indian regulatory environment. We have to understand in this Indian regulatory environment that there are different regulators which have prescribed different methodologies, and there is a total chaos in the market, in the company. Even there is a total confusion as to the value or which method to do. So there can be a RBI prescribing a different methodology, income tax prescribing a different methodology. I don't know, but if some people might have read in today's newspaper, there was a news that about 5 lakh crore amount is being debated, is being questioned by the income tax department, and 26,000 notices have been issued only in Maharashtra region only because of one particular section that says that you cannot issue shares beyond a particular value. So people were bringing in money and people were issuing shares at abnormal valuations. So all that has come to the notice of the department. 26,000 notices have so far been issued, and that is only relating to the Maharashtra region, and in the times to come, lots and lots of debate is going to be there. So I have divided into three parts. A is the transaction, B is the methodology, and C is that who the regulator has prescribed the valuation. So is it to be done by a chartered accountant, company secretary, valuer, registered valuer, who has to do it? The first thing is that in case of RBI, in case of inbound valuation, only discounted free cash flow was prescribed. So there is a thing that is written old, I'll just mention, but let's go through that what is the provision of discount, what is the provision of RBI. So we are all discussing from an unlisted company perspective, because for all the generally all the valuation, if you have a listed company that is frequently traded, then the market price is accepted as a fair price. Presuming there is an unlisted company which is receiving money from outside India, the only method prescribed by RBI is discounted cash flow. It can be small company, big company, any industry, any segment, nothing doing, only DCF has to be applied. Chartered accountant or merchant banker has to do it. Then recently, the change came in terms of the buyback of shares. So when the buyback, so you have received the money, now the investor is going and there is an exit. So at the time of exit, the recent price that came was that if there is a listed company, market price. If it's an unlisted company, highly abnormal valuation method came that you have to cap the exit based on the return on equity. And that also of the last year. So suppose in the year of exit, the return on equity is 10%. And my investor agreement says that the investor will take 30%. So the law says you can't give more than 10%. But that is applicable if you have issued the equity shares. If you have issued convertible, fully convertible instruments, then the law prescribes that you can use any of the internationally acceptable methodologies. So there are three different sets. If there is a normal inbound investment, discounted cash flow. If there is at the time of exit, you have to buy back equity shares, return on equity. And if you have to buy back other than equity shares, I mean any compulsorily convertible instrument, then you have to see the pricing as per the internationally accepted. And let me just tell you that what happens in inbound investment is, if you are receiving money outside India, then that is a minimum valuation. So discounted cash flow is the minimum valuation. But this same method is applied when you are exiting from India. So at that time it becomes the maximum valuation. So it is very important that there are lots of valuation that they are doing. So what they are doing that we have to allot at 14 rupees, so you give us 10 rupees, 11 rupees. But they don't realize that if any conflict takes place, then that same price will also become their cap. So the same discounted cash flow is minimum as well as maximum, depending on whether our country is receiving the money or the funds are flowing from India. But this method has been withdrawn from 1st of April by the Reserve Bank of India. In all the I just missed out this outbound investment. So outbound investment is when an Indian company is making investment. But if we see the valuation guidelines, then for the FDI guidelines, all the valuation standards, all the valuation things have been withdrawn by the Reserve Bank of India by its monetary policy, 1st April dated. And what they have done, they have withdrawn it, but they have not prescribed any alternative method. So there is a question whether we should apply discounted cash flow, whether we should apply all the methods. Different consultants are taking different view. Very, very important, income tax. There are three very, very important sections in income tax, and let me tell you, the entire industry is not giving heed to these three sections. And this is the last section on the basis of which I just mentioned that department has issued 26,000 notices. It came in today's newspaper, it came in 10 days back. So it is the issue of debate that is going on. What income tax says is that these three sections have actually come at a different date. So this 56(2)(7) came in 2009, then 7A came in 2010, and this 7B came in 2013. What is it saying? It is saying that if you are receiving money, then it should not be below a particular value. So like RBI is saying that if you are receiving money from a non-resident, then discounted cash flow has to be applied. Income tax is saying you have to apply another method, that is book value, net asset value method. So they have provided the calculation. It is a normal book value method with some adjustments to the advance tax and taxes payable. But as per income tax, if you have to receive the money in India, I mean through a resident only, then the valuation is net asset value. Now why and what happened? The first section 56(2)(7), when this section came, that it said that any individual or HUF, if any individual HUF receives, but then it was widened to a firm or closely held company also. So as on date, if you are making allotment of shares, if you are making transfer of shares, in both the cases, minimum net asset value has to be abided. In case of the third section, 56(2)(7)(b), it is talking of a maximum valuation. So now, under the income tax, there is a minimum valuation, below which you cannot allot or transfer. And there is a maximum valuation, but that maximum valuation is applicable only to allotment and not transfer. So there is a confusion. There are multiple permutation combinations that you can work. So I've tried to make a slide. I'm just rushing it, that I'm just taking it from one by one. In case of allotment of shares, all the three methods are applicable. All the three sections are applicable. In case of transfer of shares, only first two sections are applicable. In case of a non-resident, if you are making allotment to a non-resident, then 56(2)(7) and 7A are applicable. So when you are making issue of shares to a non-resident, then as per income tax, you have to see that you comply with the net asset value. And as per RBI, you have to see that you maintain the discounted cash flow method, provided I presume that even after withdrawal of the guidelines, we still apply the discounted cash flow. Individual HUF is one section. If you are receiving firm and closely held companies, another section. And then there is a valuer who will do the valuation. And then there are certain exemptions that if you are doing a scheme of arrangement through a court approved scheme of arrangement, or if you are receiving shares through inheritance, or if there is a relative involved, in that case, there's an exemption. As far as the allotment is concerned, the 56(2)(7)(b), if you are issuing a genuine allotment of shares, if you are making a genuine allotment of shares to certain venture capitalists, so venture capital company undertaking, if you are issuing shares, then that is exempt. Any questions on this slide? Because this is very, very interesting, and there is very less information about this particular section in the market. I mean, have you understood it? It's a post-less session, so it has to be like this, but so how do they look differently is that the first two sections are saying that there is a minimum valuation. So if you have to issue the shares, then there is a minimum valuation. And the third section is saying that there is a maximum valuation. So suppose my net asset value is 10 rupees and my discounted cash flow is 100 rupees. You cannot allot below 10 and beyond 100. But the first two sections are also applicable in case of non-residents. The third section is only applicable for residents. And the notices that I was discussing, that was only in respect of the third section because it is a recently notified section. Yes, you were saying something.
there, then all the valuation would be, challenged.
Sir, because this is a very normal question, and my answer to this is that the valuation report has to be a self-speaking valuation report. In India, if you go back to the history of valuation, then there is no expert on valuation in India. Everybody is learning. So, till 91 it was CCI guidelines. It was in 2010. Till then, till 2010, RBI was following the CCI guidelines. The CCI guidelines was totally formula based. So it was saying you take an NAV, you take PECV, you take market value, you average it. So you have to value, I have to value, everybody will be bringing at the same, because it was a formula. And formula cannot yield to different valuation. But when discounted cash flow came, then discounted cash flow, there was no guidelines, you are right. So that is the need where people say that we should have some standards. So I'll cover that because it is expected that the concept of registered valuer will come in another 4 to 6 months, I hope. And if you read the rules of the registered valuer, then they prescribe which all methods you can use. And there is also mentioned that you can also bring in they are also expected to bring in a specific standard to that.
But again, if you remember the regulations, before taking the money in from a non-resident, DCM was already paid, right? And the CA certificate used to go before the money could come in. And a special permission had to be granted by RBI. So if that has already been done, then how can income tax today say that, the premium is inappropriate? And what if the premium is inappropriate? Is it going to add to our income?
Yes.
Or is it going to...
the person who is receiving the shares, it is the other sources income of that person. So there are two sections which have been added. So one is this 56(2), and there is another section, that is section 68 of the Income Tax Act. So that 68 says that if I am showing that I have received the money, then I have to prove that I have received the money from this person, and income tax officer can check the books of accounts of the other person who has given the money, and after verification only it will be accepted. If it is not verified, then the person who has received the share capital, the income will get added back.
But again, in this case, the money is coming out of India to FIR, all the legal channels. It is showing in FIRC, it has come as FDI.
So that's fine, na? So that will be accepted. As far as the second limb is concerned, that who has given it, it will be accepted. But valuation will still be challenged. So what I'm trying to tell you is that RBI is saying this. So what people are saying, they are taking the same stand that you have said, that we are receiving money from outside India, we are using discounted cash flow method. So we are safe. But that is a wrong call. You have to see what income tax law is saying. And again, if you are receiving money from outside India, you have to see what transfer pricing is saying. So transfer pricing is another limb to this, which says that you have to do the transaction at an arm's length price. And there are multiple cases wherein the transfer pricing officer has rejected discounted cash flow as the arm's length price. And there is another case, I'll just take a minute on that case. What happened, that assessee give a projections of 10, 20, 30, 40. There was a projections. And usually assessment takes place after 3-4 years. So when the assessment took place, then the transfer pricing officer asked for the actual numbers of the assessee. The actual numbers was actually only 25% of the total numbers. So what the transfer pricing officer did was, he said that you have arrived at a value of 1,000. If I do a 25% of that, then their value is only 250. So he added back 750 that you have received it from your outside India associated entity, and on 250 he added back 10% interest. He said 25 crores is your income. So when we are preparing projections, it is not that, because people say it's a projection, whether it achieves, it does not achieve, how does it matter? It matters. So I am just saying that because when RBI has till now not challenged any valuation. So there is a valuation which is a one-page valuation, there is a valuation which is a 200-page valuation. RBI is not challenging any valuation. But income tax is challenging. So as far as the valuation is concerned, income tax will see there are lots of transfer pricing cases going on in valuation. This Shell issue, Vodafone issue is the second Vodafone. First Vodafone was the indirect transfer. Second Vodafone is this valuation issue. So this valuation issue has been questioned by the income tax authority, and they are very, because income tax targets are also not getting met. So they are going to be aggressive in that. So one thing is what a particular regulation is saying, and if the money we are receiving from foreign residents must see the arm's length price. Always deploy all the methods and then see that what is the valuation that is coming. So just keep in mind when you are doing any, and you have not discussed, but I'll just let you know. A lot of debate was going on because see, the word that is used is, if you see the section 56, then what is the language? It says that when any person receives. So a lot of debate was there that receive is a transfer, because this section 56 is, if you go into the background, then this section 56 is actually akin to the gifts provisions. So it was more or less the gift tax. Now the word that is used is any person receives. Now the challenge was that whether this receive is only transfer or even fresh issue of share is also received. So there is a very recent judgment of Sudhir Menon. That's a tribunal judgment that has come, and that judgment has stated that receives is a wider term and it covers issue of shares as well. So as on date, there is a tribunal judgment that says that even if you issue the shares, you have to comply with the income tax valuation guidelines. I don't know how many of you people are doing it, but just see, because this can have a lot of litigation aspects. I'm moving. First, the second one, that in case of transfer pricing, arm's length price has to be given, and arm's length price is not defined, that which is the arm's length price that we have to use. Then in income tax, there is another method, ESOP tax. So if in a company is issuing ESOP, then at the time of exercise of those ESOP options, the tax has to be payable by the employee. And the valuation has to be determined by a category 1 merchant banker, but the valuation methodology is not prescribed. Our view, how we are doing this merchant banking valuation is that because in ESOP, the employees generally get a minority shares. If you see any ESOP scheme, then there will be 0.5%, 1%, 2%, 3%. It will not be more than 5% in any case. So this ESOP valuation section is talking of valuation. But very interesting concept has been brought in Companies Act 2013 that says that any property, any stock, any shares, goodwill, it is covering everything. Anything and everything that is related with issue of shares or securities, there has to be a valuation by registered value. So if a merger is taking place, registered value has to value. If it has a delisting taking place, registered value has to. If you are issuing a fresh shares, registered value has to. So there are different regulators prescribing different methodologies. So I'm just skipping all this. This is actually what is detailed. The same things. And just stopping a second on the discounted cash flow method. If you see discounted cash flow method, there are projections, and then there is perpetuity. Usually the perpetuity constitutes a very large number of the total valuation. It can be as much as 80%. So what is important is that when we are stopping at a year, so suppose we have prepared projections for 5 years. You can prepare for 5, 3, 10. Then we must see that the normal growth period we have covered the normal growth period. And when we have stopped and applied the perpetuity, at that time, the growth rate has been stabilized. So this is just which I wanted to mention. This is all that we have already discussed. So I'm skipping everything. Another interesting thing is purchase price allocation. So, if we are doing a intangible value, so suppose you have acquired a business, a company A has acquired a company B. Now, how to account for it? How much do I give value to the tangible assets and how much do I give value to the intangible value? So, when a valuation takes place, then for accounting purposes, a purchase price allocation is generally followed. And what it does is that first it takes over all the assets and liabilities at the transacted value. Then it separately values the intangibles, and if there is still any difference, then it is giving to the goodwill. So intangible valuation, if any, to be separately valued, it is only from an accounting perspective. You can say that I have a brand valuation. Brand valuation is a different thing. But if I am saying overall intangible valuation, then intangible valuation is not something that you do intangible and you add it to the normal business valuation. I am just repeating it. Intangibles is just for the purpose of doing my accounting in the books of account. Now I am coming to the raised valuer section. So if we see raised valuer, there is section 247 of the Companies Act 2013, which has for the first time segregated and bifurcated the valuers into two parts. So till now we were known as valuers. Now we will be known as either a financial valuer or a technical valuer. When we are talking of a business valuation, then it's a financial valuation. When we are talking of a property, immovable property valuation, then that is basically a technical valuation. So how the draft rules, this is all as per the draft rules, the rules have not yet been finalized. But what the draft rule says that a chartered accountant, company secretary, cost accountant is qualified for a financial valuer. A merchant banker is qualified as a financial valuer. There is a requirement of 5 years of experience. The law says that 5 years of continuous experience. And the type of valuation it can do is stock, shares, debentures, securities, largely the business. If we talk of technical valuer, then technical valuer is a member of the Institute of Engineers or the Institute of Architects. There is a lot of debate going on it, whether it should be there. There are lots of valuers who are registered under the Institute of Valuers. They are saying why to create another valuation. Lots and lots of discussions. But what the draft rule says is that the financial valuer will be valuing the business. The technical valuer will be valuing the assets. And then there can be so if I am doing a business valuation and I require the help of a technical valuer, I can appoint and then I can do it.
Yes.
Please.
This is pertaining to this technical valuer section. The draft rules under Chapter 17 have been circulated by the Ministry of Corporate Affairs in February, and which clearly states that chartered engineers who are in practice for more than 5 years will not be treated as registered valuers under the Companies Act 2013. But these are yet to be finalized, as you said. By when can this be finalized, and what do you feel is going to be the outcome of all this?
Sir, this is the rules which are the final rules in the public domain. And this, what I'm telling you is as per the final update from which is formal. Informally, lots of discussions are going on, whether it should be there, whether it should not be there. To the best of my knowledge, the particular subject is on hold, because the Companies Act has been enacted. So there was a hurry to enact the law. The law has already been enacted. And now what is important is actually, because there are two important sections which have not been enacted in the Companies Act. So one is the NCLT provisions, because there is a SLP going on against the SLP provision, these provisions. And the second provision is that of this registered value. So I don't think it coming before 4 to 6 months.
CM comes from the Ministry of Corporate Affairs?
Yes.
They take the final decision.
Yes. So these are the areas, if you have to further issue of shares, if you have to do a compromise or arrangement, there is a winding up, there is a non-cash transactions with directors, there is an exit to minority shareholder, there is a corporate debt restructuring. In all cases, the valuation has to be done by a registered valuer. Now what is interesting here is that there are some kind of rules that have, for the first time in the history of India, that have come from a valuation. So how people were valuing, like you see, like Vandana was just discussing that there are valuers who are just taking the projections and valuing it. That is going to change automatically, because we have seen if there is a stronger law, then it stops such things. If there is no law, then there is all the things keep on happening. So a very, very significant step that the ministry has, despite a lot of opposition, that has come in the act, not in the rule. So section 247 says that the valuer has to exercise due diligence. Now due diligence seems to be a wider word, because whether due diligence means that I have to check that whether this balance sheet is reported, fine, signed, or due diligence is that I have to see that whether, now if I am doing Satyam valuation, how can I check that whether there is fixed deposit, I am seeing there is fixed deposit. I will not, when I am going, I will not write to banker that you give it to me, and so this is a question mark, that what is due diligence? How, because valuations are basically dependent on the data that is given by the, so data is given by the company, the due care is taken by the valuer, industry verification is there, different benchmarks are applied. If we feel that the value, the cash flows are high, we can keep a higher discount rate and all that things can be done. But how can we authenticate that the figures that we have got, those figures are correct? So this is a question, and let me tell you, very, very grave charges are imposed on the valuers. If the valuer is not doing valuation properly, he has to refund the money, he has to, I mean, he can just, his name can be struck. So these rules are very, very stringent, and we expect to see some quality valuations coming in down the line. How much time? No, the next speaker is here. So I'll take 5 minutes, and I'll ask for, we'll take FAQs for five minutes. I'm just covering some of the tricky issues. First thing is discounts. So first of all, we have to understand that why these discounts and premiums come into play. There is a particular method which is resulting in a particular value. So suppose there is a CCM method. CCM method results in a minority value. Now I have to do minority value, but I have applied discounted cash flow. I have to do minority value, but I have applied comparable transaction multiple. So if we use a different method than what we ought to have used, then there is a inconsistency in the valuation, and there is a need of discounts. Now discounts are of two types. First discount is an entity level discount, and second discount is a shareholder level discount. So when we are valuing a so at times we are asked to value a company, at times we are asked to value a shareholder. So 2% shareholding is a minority or control. If we have to value a 2% shareholding, there is 100% shareholding. If we have to value a 2% shareholding, which method we should use? Should it be a minority valuation or should it be a control valuation? Like? So that in valuation, what we have to look at is not a formula. I got an answer that valuation is not a arithmetic, it is not a science. Valuation is as good as the logic that we place in the valuation report. So all of us can get a different valuation number, but if all of us can substantiate, then all our valuations are correct. If a person is having 49% shares, like sir has already clarified, so 2% is not a minority, 2% is a control. So 2% wherever it might be, it can be like the possible election results, that a person can go anywhere and it can get any seats. But the important thing is, when we are valuing an entity, then we have to see the key person, contingent liability, holding. So there is a company, if you are doing business in a company directly, there is a different value. If you are doing business in a subsidiary company, and I am a holding company, so we are valuing a holding company, but the business lies in the subsidiary company. There is a different value because there is a holding company discount. there is a company which is having 4 businesses, sugar, power, different. If we do a sum of the part valuation, then the sum of the part valuation will not be, I mean, if we do sugar valuation, power valuation, pharma valuation, 10, 10, 10, the value of the company most likely will not be 30. It will be way below that. It is most likely to be 18, 20. Because when there are different businesses, then there is a diversified discount. If the businesses are such that they are adding value to each other, maybe there is no discount. But if there is a diversified businesses in one company, most likely there will be a discount. And that is why most of the demergers happen. You see, whenever demergers have happened, a spin-off has happened, it has resulted in a value creation. And the logic to that is that all the different businesses are, after the demerger, being run under a separate entity, and there is a proper control, proper focus of the management to that business. When we are valuing at a shareholder level, then we have to see that whether the shareholder is having control. And control is not a normal thing. For a control, we have to see a person might be having 0.1% share. But there might be a veto power that the shareholder has pursuant to a share purchase agreement. So at times, a shareholding matters. At times, the power to control the board matters. But at times, the shareholder agreements give a different insight that what should be the. So my only submission here is that don't go into the numbers, go into the legal documents, go into the internal things, go into the industry. And once we do a total holistic thing, then a valuation can be true and fair. Why premium? I mentioned that the price of shares, those are running in the stock market is minority. But you see, whenever the acquisition of any company takes place, it does not take place at the particular running price. It takes place at a 30, 40, 50% premium. Because of that, because the market price is minority and the transaction price is control. So that is how the thing goes. Excess cash and non-operating, I have already mentioned that we have to separately add to the normal business valuation, the excess cash and non-operating asset. But again, there can be a scenario wherein we are running an business on a very expensive asset. So that asset is not a surplus asset, but that asset is not resulting in adequate cash inflows. So what we can do is that the only solution, because when you will go to the investor will give you, mostly the investors give valuation on the basis of cash flows. So if the business will not yield cash flows, then the only option to that is restructuring. So you have to sell off that asset, you have to buy a cheaper asset. But these are the challenges that we see from a transaction perspective. When a M&A is taking place, then these kind of challenges. So valuation is not a number crunching. Valuation plays a big role in a transaction structure and advisory. If there are cross holdings, how to value it? So some people, what they are doing, I am having a holding company, there are subsidiaries companies, I have to value a holding company. So they say that we receive the dividend from the subsidiary companies, we add those and we value. But the correct picture is that you should separately value each of the separate entities. You should see whether there is a need of a holding company discount, and then the final number has to come. Accounting practice is very important. When we compare the comparable companies, then suppose there is a company which is paying a minimum alternative tax, 20% tax I am paying. And I consider a comparable company which is paying a 30% tax. So there is a need of adjustment. How accounting is taking place, how tax is taking place is very important. There is a company which is a loss-making company. You can say it is having no value. But you see, the loss-making company gets a profit-making company, and the profit-making company was searching for a company which can set off the losses. So there is a value. So value lies in who is the buyer. Standalone, it cannot be a value, but it can give to a different results from who is looking at the transaction. Now this is the last slide that I'm concluding, and the slide is saying that which are the methodologies, what the value results, and where it is useful. So if we are using net asset value, book value method, then generally it results in a minority value, and net asset value is always will always lead to the equity value. If we are doing a net asset value intrinsic value method, fair value method, then the valuation is most likely to be a control value. But again, the result of net asset value is always equity value. If we are valuing comparable companies multiple, then there are certain multiples which result in equity value. There are certain multiples which result in enterprise value. But by concept, the comparable companies multiple method results in a minority value. So if we go from a PE, price earning ratio, or we go from a book value perspective, then it's a equity value. If we go from a EV/EBITDA multiple, if we go from a earning before interest and tax level, then it results in a enterprise value. In case of comparable transaction multiples method, the same concept applies as to the ratios. I mean, the PE or EBITDA, the ratios are same. The only difference is comparable transaction generally results in a control value. And lastly, when we are applying discounted cash flow, then discounted cash flow always apply control value. But discounted cash flow can also be done in two manners. So there can be a discounted cash flow to firm, and there can be a discounted cash flow to equity. So whichever ways we are doing, the same way it is going. So I think I am concluding my session here, and I would be happy to take any of your queries. Yeah. Thank you. 4% of cash. Suppose there is a business which requires 4% cash of the sales, and your company is having 20% of cash. You take an example, you have just sold an asset. When you have just sold an asset, you have got money. You have not deployed that money in any of the business. So that's a surplus cash. It happened in case of Infosys. And if you see the balance sheets of substantial companies today, then almost all companies are having the surplus cash. The reason is that they are not finding an adequate opportunity for acquisition. But again, I am saying, listed companies don't get valuation of the surplus cash. But fundamentally, if you say, then there is a value. If you have to dispose, if you have to sell off, suppose a transaction is taking place today, then what will happen? You will take back your cash and you will say, take the business. But when a company is a listed company, the price is a running price. It is not a selling price. It is a running and minority price. So listed company does not factor in. If you have to do an independent valuation, you will add on. Either you will add on or you will take it and then you will give it to the business value. Thank you. Yeah. It covers that you can use either income or asset or market, and all the methods that I just mentioned, it has mentioned all the methods. It is not saying you use A method or B method. It is saying you use any of these methods. So the rules are very liberal and you can use any of those methods. I mean, the challenge there is if a person is not knowing which method to use, then that's a tricky issue.
Can we use the land and building method also?
Sir, land and building method for valuing land and building?
Assets.
Yes, why not?
And replacement cost method for plant and equipment?
Yes.
Are there any specific regulatory provisions with respect to outbound transactions?
Yes, so what the RBI law says is that if you are making investment outside India, then if the transaction price is more than $5 million, then you have to take a valuation of a merchant banker. Otherwise, you have to take a valuation of a chartered accountant or a CPA outside India. So which method to use is not prescribed. But because the inbound guidelines prescribed for discounted cash flow methods, so people were generally using discounted cash flow. Even for outbound, but that is not technically correct because discounted cash flow is not the minority valuation method. So to my view, we should use discounted cash flow for majority, 30-40% if you are acquiring. If you are acquiring 3%, 4%, use a comparable companies method. That is easy.
One of the things you said that if a company has 4 businesses, in totality the valuation is discounted. But isn't it exactly the other way? Because if the company has 4 businesses, it has diversified, it has risks are distributed. If one of the business goes down, the other 3 businesses are there to cover. So why is there a discounting in that case instead of having a plus?
What happens if the balance sheet is 1? If you see the laws of the country, then when you prepare a balance sheet, you don't prepare a segment-wise balance sheet. You give a segment-wise reporting, but you give it only till the EBITDA level. You can't tell me that this much net profits is there. So what happens? In the last 4 years, what has happened? Every company took debt in 2007-8. They were expanding, and there were lots of CDR and distress cases. So I, as an investor, I would like to understand how much debt you have deployed in this business. What is the net profit of this business? From a segment reporting, you can't get.
Segment reporting accounting standard is very clear, and once you give that, it gives the part of the till profit. Apart from that, it gives the loan, etc. where utilized major amounts are always given in.
But if you see the segment reporting, then only EBITDA, till EBITDA people are giving. People are not giving till PAT level. The reporting is, so there are 2 things. One, because I'm a chartered accountant, so I'm telling from a technical perspective. But otherwise, you see, every person would like to understand. So there are 2-3 things. One, that if I am doing 3 businesses, then which business is my focus business? It is not clear. I can be earning from one business, I can be deploying it into another business. I can be having a profitable business, I can be having a loss-making business. So the point is, it makes sense for companies to do different businesses in different companies, because from an investor perspective, if you are interested in business A, you would not like to take the assets, liabilities, loan liabilities of the business B. Secondly, it is very clear, I have earned 100, I have got 10 rupees. In case of a diversified business, when the risk and rewards of different businesses are different. I am giving you an example. There is a company which is into lighting business, and that is also into steel business. The lighting business, that's a live case. The lighting business peers, you compare with Havels, you compare with Sylvania, you compare, they are getting 19 to 20 PE multiple. If you compare with steel, then the company, the compare JSW and all those companies are getting a 9 to 10 multiple. That company is only getting a 5 multiple. Why? Because there is a question mark in the market that what will happen. I mean, there can be a lot of siphoning of money. There can be a lot of structured transactions that happen, and investors don't get a clear picture. In all the cases, if you go through demergers, 80% of the transactions would have created a value after the spin-off. You take Reliance is a landmark case. The value that Reliance is having today and the value that, so it has grown by 4 times, I think.
Principally, it should have been different, because once you are valuing one business, you are valuing other business, you are independently valuing a business which takes care of all the risks and perspectives of all the businesses.
Sir, that is what I'm saying. So what you do, you value A, you do value B, and you do the sum of the part valuation, right? But when all the businesses into one, you cannot do valuation on that basis, because there can be a business which is a profit making business, there can be a business which is a loss making